All right. Today is Monday, March 27th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Let's begin with the most important stories of the day. Of course, overnight we got the news that your beloved CEOs are in China. And they're of course led by Tim Apple. And the Chinese threw a jubilee for all of these American CEOs. It's a love fest. And of course, the Chinese propaganda machine is now saying, look, this is how America, that claims to have an open market capitalism bullshit, look at how they treated TikTok CEO last week. And look at how we are treating Tim Apple with love and respect. You're welcome to do business in China. And you know, recently I've been hearing about this anti-China rhetoric on TV. China, 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 all the time. I'm supposed to be hot about China. And my question is why? Why am I supposed to be hot about China when pretty much everything around me is made out of China? And oh, by the way, my beloved CEOs, they're all in China kissing the ring. So you want me to be angry and hate China when America's CEOs are in a love fest in China today? Something doesn't add up here. Or maybe this is all about prepping our society for the next money laundering operation in Taiwan, because the Ukraine thing, that's not working out anymore. They tapped out at about $100 billion. So now, since the Ukraine strip club is no go anymore, we got to open the Taiwan strip club. And the beauty of the Taiwan strip club is it's not just Democrats who are going to juice out taxpayer money. It's the Republicans too. Maybe some of them are not on board with the Ukraine thing, but you watch. They're not going to hesitate to spend trillions of your taxpayer dollar in the so-called Taiwan operation. Meanwhile, here in America, we're having a banking crisis. A recession is looming. They're not gonna give a shit. So before you ask me to be so hot about China, start with the CEOs, who've been, by the way, selling the American worker to China for years now, selling trade secrets, caving down to the demands of the Chinese government and changing maps like Apple did before, and yada, yada, yada. But at least this was assuring to US investors that probably China is not going to retaliate and crack down against Apple, Nike, Starbucks, because as the saying goes, keep your enemies closer. And the Chinese know how to play the game. Your beloved politicians, on the other hand, they're completely zombified. And the next story, of course, is the banking crisis, if you may. Although all day I've been hearing in the business news that the banking crisis is contained, it's back to being idiosyncratic again. Now, we got the news in the morning that First Citizens Bank is now acquiring SVB, also known as Silicon Valley Bank, which went kaput about a couple of weeks ago. But here's the catch. They're doing so by a $70 billion credit courtesy of the FDIC, or in other words, the taxpayer money. You and me, baby, we're paying for all of this. They say, oh, it's not directly taxpayer money, but they're going to bite you in the ass one way or the other. You know the deal. I'll wait till you find out the skeletons that are hiding in First Citizens Bank closet, because that's another one that maybe will blow up too. And when we talk about the casualties of this banking crisis, how about the Saudi National Bank? We know that based on his comments regarding Credit Suisse, the Swiss bank went kaput too. And this is kind of sad because all what the guy said is, in answering a question, would you provide Credit Suisse with more money? We know the Saudis bought a chunk of Credit Suisse, right under 10%. And all what the guy said is absolutely not, because we can't afford to go over 10% due to regulatory issues. And immediately, based on that comment, the market started putting two and two together and said maybe they're not providing any more support to Credit Suisse, not because of regulatory issues, but maybe because the bank is about to collapse. And immediately the credit swaps shot up higher, and in a matter of days, Credit Suisse went down. And with it, this guy also went down because he said what? He said pretty much nothing. Yet the damage is already done. The Saudi National Bank is now losing $1.2 billion. And this is what I hate about financial markets, because you gotta be kind and gentle in your words, because God forbid the algos might misinterpret the information that you're giving out as panic and sell everything. And therefore, you hear in Bloomberg and especially CNBC, where the algos are wired to listen from, we got to be careful what we say here. We got to be careful not to panic the market. It's so kind and gentle. God forbid the stock market goes down 2-3% because of real data. But when it comes to pumping the stock market, they have no limits at all. AI this, AI that, idiosyncratic this, jerk off that, doesn't matter. They have no limits at all. If the algos catch up on something fake and we see some stock popping 10-20% or nothing, there's no problem here at all. Who cares? The mom and pops get sucked in and they get slaughtered later on. That's part of the game. The other thing I want to talk about before we move on to the In Focus segment is what's going on in the market theme. What is the market saying right now? Because a lot of you say, Maverick, this is a challenging market. I'm just going to stick to betting basketball now. To each his own. Maybe you should have bet San Diego State because we are here to win it, baby. The whole thing, not just the Final Four. But anyways, in the aftermath of the collapse of banks, and especially after the FOMC, bond traders seem to be vehement that this is going to be a recession, and therefore bond yields going down, gold catching a bid, oil crashing. You know the story. And especially when it comes to the bond market, because when we look at the yield curve inversion, the 2 versus 10s, this is one of the most aggressive yield curve inversions we've ever seen. And this indicates that there is a high probability that the economy is about to head into a recession. And usually, when the yield curve starts to recover, aka steepens, this marks the beginning of the recession. Now, the yield curve inversion itself doesn't tell you how long and how severe the recession will be, but it tells you that the probability is just too high. Yet there is another theme that is still lurking on, which is the expansion/the delusion theme, in which a lot of market participants are now buying technology, big caps, small caps, Mama Cathy Wood kind of names, doesn't matter, because they believe that bond yields are going down, no more rate hikes, and this is supposed to be good for the economy and good for overvalued technology stocks. But what about the recession part? I guess people buy more iPhones during a recession. But anyways, last night we talked about how everybody seems to be dismissing the inflation problem, as if because we have some bank failures and now we have the risk of recession looming, the risk of inflation all of a sudden gone. It's taken care of. It no longer exists. Which is absolute bullshit, you know that, and we talked ad nauseum in last night's video. What if, since everybody's dismissing the risk of inflation, what if we have a stagflationary crisis? What if we have the recession risk looming because of bank failures and tightening credit conditions? But what if inflation also closes in? Because there is no guarantee that a bunch of bank failures and some tightening of credit conditions will take care of the inflation problem. And if this is indeed going to be a stagflationary crisis, then a lot of assumptions will be proven wrong. For example, the recession crowd who are saying, hey, gold will go to the moon immediately. Maybe they're going to be wrong in a stagflationary situation. Maybe the crowd who says you got to stick with the big caps and chips and overvalued technology stocks due to safety, maybe under a stagflationary scenario, their assumption will be proven wrong because yields will stick at a higher place. And that's not good for overvalued companies. I mean, look at what happened today in the market action. We'll look at the heat map all in all. Okay, banks are catching a bid. Short covering, whatever. But then you got gold miners down for the day. That's not recessionary. You got energy stocks rebounding significantly higher. That's not recessionary. A lot of cyclicals and industrials also caught a bit. That's not recessionary. And then we look at the big caps and technology, weaker today, lagging the action in the rest of the market. That's not expansionary. So what is the market saying today? Obviously, it was an inflationary theme, led by energy stocks. Bond yields recovering again, the dollar starting to creep back higher again, and we see commodities recovering from the steep declines from the last few weeks. What if this is a stagflationary crisis, ladies and gentlemen? Eventually, we're going to head into a recession, but maybe not right away. Why does everybody dismiss the risk of stagflation as if it never happened before? It did happen back in the 70s. So what are you saying, Maverick? Are you saying should we stick with the expansion theme, with the inflation theme, with the recession theme? This market is so confusing. I better just go to the casino. Well, hold your horses. Notice the outperformance of healthcare and consumer staples, regardless of which theme it is. Expansion, healthcare, consumer staples, holding pretty good. Recession, they caught a bit. Inflation, they caught a bit. Why not stick with these names? We see a lot of value lift in big pharma names, for example. A lot of them went down big year to date because nobody wanted them. When the market was under the delusion, they were about to have a soft landing and the Fed is about to back off and you got to pump technology stocks higher. They gave you a nice dip in these big pharma names. Even biotech, not all of them, but the value names in biotech such as Regeneron, which I happen to own in my portfolio, but I'm going to talk against my book here. Look at the daily chart for Regeneron. That's overextended. That's a reversal candle, maybe we should see Regeneron moving down for a little bit, and then that could be a value pick. But the majority of value is in big pharma, not in biotech. When it comes to staples, I've been floating this name for a while now, GIS, General Mills. Nobody loved the name in the beginning of the year. They've been dumping all of these consumer staples names, and I've been saying, folks, I will continue to add to these positions because they're going to perform in a recession too. They continue to provide insane profit margins while technology companies are collapsing when it comes to fundamentals and earnings reports. Revenue growth, not so good. Net income growth, not so good. Balance sheets, ugly. Cash flows drying up. But somehow that's safety. When the recession happens, are we going to buy more iPhones or are we going to buy cereal from General Mills because, God forbid, we might die and that's the only thing we can afford? And look at this. The stock went down in the beginning of the year by more than 11%. Dead money. Nobody wants it. You're wrong, Maverick. You're missing the chance in chasing technology. Okay. While you say that, I'm going to continue to buy because look what happened here. The name popped higher from the lows all the way to the highs, up by about 16%. Now we got a little too hot in a short amount of time. We have a shooting star candle. So again, I'm talking against my book. You might want to short the name for a little bit here, and then when it stops and rebounds higher, it could be a good add. And we have plenty of names that continue to perform regardless of the theme, and they provide reliable performance during recessions. Now, if we do have a crash and everything goes down together because of the ETFization impact, sure, everything will go down. But which names will recover the fastest under a recession scenario? Which names will continue to perform in a stagflation scenario? I think the answer is clear. But folks, I've been reading a lot of financial news over the weekend and I stumbled into this. It says U.S. reportedly considers more support for banks, not people, banks, while giving First Republic time to shore up the balance sheet. Oh, how generous of them. Have you noticed how kind and gentle the Fed is when it comes to banks? And I wondered, isn't the situation that we're in right now regarding the central bank policy is a choice between saving people or saving banks? And this leads us to the main topic of tonight's program, and here it is. In focus tonight. Duh! What if I told you that central banks are broken between two hard choices? Save people or save banks? The answer might surprise you, but let's begin with this. You know, everybody's dismissing the inflation problem, but we'll look at the facts and the data. We'll look at the latest reading in the CPI, aka the CPI, the inflation reading here in the US. Core inflation actually moved higher month over month. In other words, we see a re-inflation problem in the US, not disinflation as Clown Powell said 15 times in the previous FOMC meeting. Matter of fact, when we look at Clown Powell's favorite inflation indicator, core services ex housing, this reading made a new high, the highest reading since the summer of last year. So while the media says, oh, inflation is not a problem right now, we have a recession looming problem, and maybe the recession looming problem will take care of the inflation problem, and somehow we're all gonna live happily ever after. The reality says inflation is still a major problem. We're not even close to defeating inflation. Americans are now spending an extra $371 a month because of inflation. We know that credit card debt is skyrocketing in this country because people can no longer keep up with the rate of inflation. Matter of fact, 27% of those struggling paycheck to paycheck, eyeing more credit card debt. They lost to inflation, and the only choice they got right now is to continue to dig themselves deeper and deeper into the debt hole. I don't know how this is going to end up well for the U.S. economy and the entirety of the consumer, not just the paycheck to paycheck crowd, which by the way means most Americans. We'll look at those who are living paycheck to paycheck and they're having issues paying the bills already. About 52% of those say that they're considering opening up a new line of credit, and this is all due to the inflation storm. Gen Zers are now racking up more credit card debt than any generation before. And if we have any Gen Zers listening tonight, you know when they say to you, welcome to being a grown-up, what they mean is welcome to getting financially because you're racking more credit card debt right off the gate. On top of the student loans, of course, insane rents all over the place. You're not going to be able to own a home until you're 90 years old, and that's a tragedy. And of course, they say the rate of inflation, according to the CPI, is 6%, 5 point something percent. It's no biggie. We can live with that. But while the CPI says 6%, electricity prices are actually up 14+%. Not to mention, of course, gas bills. Here in the state of California, gas bills are shocking to the point where restaurants are now closing business. They can no longer afford to be in business because of the insane skyrocketing gas bills. And how about those auto loans? With new and used cars prices skyrocketing higher, Americans are now paying more than ever in their auto loan payments. Take a look.
New cars still come out to nearly $50,000 and used $28,000 on average. Combined with APRs that can be as much as 11%, monthly payments are skyrocketing. 1 in 6 people who have recently financed a new car committed to monthly payments of $1,000 or more, the highest on record.
And it doesn't stop here. From groceries to clothes, inflation-worry Americans flock to cheaper products online. Thank you again to China, right? Who we're supposed to hate right now. But you can see pretty much in every category, Americans are now in the hunt of cheaper products. They can no longer afford to buy all of this overpriced crap. So now you're choked up because you're paying more at the grocery store. You're paying more for electricity. You're paying more for gas. You're paying more in auto loans. You're paying more in credit card debt. But the biggest tragedy is housing. The headline from CNBC reads, Wall Street has purchased hundreds of thousands of single-family homes since the Great Recession. Here's what that means for rental prices. And spoiler alert, it means, once again, you're gonna pay more out of your income than ever before on rents in this gangsterism economy. Today, I read the headline here in my city of San Diego that a new report claims Blackstone Group is buying San Diego's affordable housing and hiking up rent prices as much as 64%. Take a look.
Well, as homelessness surges across San Diego County, pressure is on affordable housing to increase. A new report claims one landlord is eliminating thousands of affordable housing units while hiking up prices. Community groups rallied together today, urging local leaders to enact stronger tenant protections. NBC's Chandel Miniz has their call to action.
San Diego tenants and apartment complexes just like this one are rallying against America's largest landlord, the Blackstone Group.
Celeste lives in El Cajon. In the cold months, she didn't have any heat in her home with her toddler daughter.
October was really cold in 2022. The lady basically told me, well, you only have a few more months of this, just hang in there. This is illegal. I'm not a fool.
Viviana lives in Chula Vista with her husband and 6 children.
We want to live in peace, and we want to be able to have, a manager that we can rely on when something goes wrong. So right now we don't have that.
What these women have in common is they both rent from the Blackstone Group, one of the largest private equity companies in the world. Saturday morning, the Blackstone Tenants Union released a report called Blackstone Comes to Collect, how America's largest landlord and Wall Street's highest paid CEO are jacking up rents and ramping up evictions. The report highlights San Diego County, where Blackstone purchased thousands of affordable housing units in 2021. As renters moved out, the company raised rents in some units between 43% and 62% in 2 years.
And you could tell me all you want, hey Maverick, this is capitalism, free market, Blackstone is free to do whatever they want to do. Bullshit. This is not capitalism. This is gangsterism, and I'll tell you why. Let's say I'm a small business owner. I own a restaurant. If I want to expand and open a new branch, right? A new restaurant, I have to take a loan from the bank. Now, during QE, when the Fed was pumping liquidity and keeping interest rates at zero, even at that time, the bank would charge me a certain percent. I will have to pay interest rate on the loan. I would have to qualify for the loan. Not so much for Blackstone. They can take whatever loans they want, billions and billions of dollars, interest-free, zero interest rates, thank you to the Fed. And they can scoop up all of these single-family homes, and now they have a monopoly over it. You want a home? You gotta pay more. Things are not cheap these days. Own nothing and be happy and keep paying and paying for the monster as they continue to jack up your prices and your rents higher and higher and higher. And if you don't pay, they'll drag you out of there in no time. Evictions are now skyrocketing. Thank you again to Blackstone. Evictions have been increasing across the country as landlords of all sizes seek to recoup money they lost during the pandemic because of federal and state eviction moratoriums. Oh, you mean when the government was paying your rent instead of your Renters? Anyways, data from Princeton's eviction lab, which monitors 32 cities and 9 states, shows that more than 9,300 evictions cases were filed in the first week of January, compared to just over 7,700 cases filed during the week at the end of December. A Blackstone representative told Insider that the company had the most favorable resident policies among any large landlord in the U.S. Keep your mouth shut and be happy. And pay the rent, of course. And look at this. They say that rents in Orlando up 8.9% year on year. In San Diego up 6% year on year. And this is according to CoreLogic. I'd love to hire some of these people to find a home for me where the price went higher by 6% only in the city of San Diego. Maybe they're talking about a trailer or a van, perhaps? Because in reality, we know that rents went higher by double digits. And folks, when you talk to younger millennials or Gen Zers, you're going to realize that the majority of Americans are actually cheering, keyword cheering, for an economic crash. Crash the living hell out of the stock market and crash the living hell out of real estate prices. Let it burn. Why do a lot of Americans feel like that? The answer is because the American dream is dead. It's now owned by Blackstone. It's now owned by foreign investors who are scooping single-family homes in this country. It is owned by so-called investors who scoop up a bunch of homes and they list them on Airbnb. That's where the American dream went. And folks, it's not just in America. Look at the inflation rate in France, hitting a record. We all know what's going on in the streets in Paris right now. Absolute chaos. Look at food inflation in Germany. Unbelievable. Skyrocketing. It continues to move higher as we speak right now. Cooling inflation my ass. Food inflation in Spain at double digits territory. And somehow we're going to declare victory against inflation. Inflation is gone now. The so-called English breakfast basket skyrocketing. Food prices in England and the UK are soaring right now as the inflation rate rises above 10% once again. Even pizza and pasta prices in Italy are skyrocketing right now. Do you need any more evidence that inflation is not dead? That inflation remains to be a major problem. And if you're hoping that a bunch of pathetic banks blowing up, somehow that's going to take care of the inflation problem, you got another thing coming to you. Is this why we're stopping the fight against inflation? Because we have to rescue a bunch of banks that were supposed to blow up anyways? Are we supposed to stop the fight against inflation because of Silicon Valley Bank, the corrupt assholes that they are? Take, for example, the CEO who's been dumping shares ahead of time. Are we supposed to stop the fight against inflation and spend billions of taxpayer money to bail out the same Silicon Valley Bank? Where insiders sold over $84 million worth of stock in the last 2 years? Where employees received bonuses on the day the bank failed? We're talking about millions and millions of dollars. The same bank, the moment UK HSBC took over the Silicon Valley Bank unit in the UK, they handed out $18 million in bonuses. The same Silicon Valley Bank, by the way, who increased lending to insiders ahead of the collapse dramatically. If this chart doesn't show you a fraud, I don't know what will. This is a scam, folks. They knew that the bank was about to go bust. They took out loans to insane levels, over $200 million worth of loans right before the crash. They took bonuses, they sold stocks. Are we supposed to pause or end the fight against inflation because of this crash? How about First Republic Bank, where executives sold millions of dollars of the company's stock 2 months before this banking crisis even began? Folks, they knew. They all knew ahead of time this is bound to happen, and they decided to cash out. And now they're blackmailing all of us. You guys have to live with higher inflation because, God forbid, if we continue to fight inflation by the Fed raising rates, more banks might blow up, more gambling units in the economy might blow up. This is the choice, ladies and gentlemen. And I think that you know for sure that central banks, if given the choices between saving people from inflation or saving banks from their own misdeed and lack of risk management, or they're going to choose the side of banks, no problem at all. In summary, when everybody talks about, oh, we have a recession risk looming because of systemic risk, because we have all of these banks with bad behavior for years about to blow up, and maybe that's going to be good enough to tackle inflation down and end the inflation problem, and therefore the Fed has to pause and stop right now and even start cutting rates? Isn't there a high degree of delusion in this assumption? Let me know in the comments. But for now, we have to move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average closing in the green, up by 194.55 points or a gain of 0.60%. The Nasdaq is the laggard today, closing in the red, down by 55.12 points or a decline of 0.47%. The S&P in the green by 6.54 points or a gain of 0.16%. We'll look at the sectors. At number 1, capturing the gold medal, energy. Number 2 for the silver, financials. Number 3 for the bronze, industrials. Meanwhile, the laggards, led by communication services and technology. What is the theme today? Mixed. Energy leading, that means inflationary theme, but financials also leading says, hey, we have some short covering here. Now, the fact that we have technology and communication services lagging tells us that this is not an expansionary theme. But it doesn't matter what theme it is. Look at where defensives and healthcare are. They continue to perform regardless of what theme it is. When it comes to the breadth, we see the NYSE 76% advancing versus 22% declining. The Nasdaq, believe it or not, despite the fact that big caps were down, the breadth was actually more healthy than the last couple of weeks because we have 57% advancing versus 39% declining. We'll look at commodities. What do we see here? A major bounce for oil, gains of over 4% apiece for the WTI and Brent. Even gasoline RBOB scored higher gains, worth about 3.5%. Heating oil closing the day with gains of almost 2%. Natural gas was the laggard of the day, but we have a contract change here. The new contract is actually doing a lot better than the old contract, and it did close in the green today. And of course, there's a lot of talk about what happened today. Why did energy rebound today? Was it due because of short covering? Was it due because of dip buying? What was the reason behind the rebound in energy prices? It could be possibly because of the deal that we got in the morning by Saudi Aramco investing billions of dollars in Chinese petrochemical companies, which solidifies that the Chinese demand for oil will indeed remain high for a long time. And that gave some assurances for oil investors that, hey, you don't need to panic right now. Maybe oil prices are going to stabilize here. Now, folks, all in all, I believe that the recession theme will win at the end, and that's not going to be good for energy. So you have to be picky, and therefore I announced that I'm reducing my energy holdings. For now, I did not make any moves, but I'm well hedged. I have a lot of puts, but I want to reduce my holdings to Chevron, a refinery play. I like Valero a lot, and maybe SLB, depends on how it recovers from this point on. But I also have Occidental, I also have Hess, I have many other names. In natural gas, I have Coterra, I have EQT. As an energy investor right now, you gotta be careful despite all of this rebound that we got today, because you have no idea whether it's gonna last or not. Is it a relief rally or not? I think that the recession theme is really strong right now. It's gonna be the predominant theme from this point on. How would oil perform in stagflation if it's not a recession right away? It's going to fare a lot better than most people think. We might see oil prices sticking at the 70s, for example. That will be good enough for energy companies to turn a profit. But you have to hunt for value. You can't just blindly buy energy stocks. You have to look for value within energy. Anyhow, when it comes to metals, we know the dollar was down, but that did not help metals at all. Especially gold and silver. They were down about 1% apiece. Actually, gold was down by more than 1.5%. What is the message here? Maybe we got too excited about the recession theme. Maybe there is a little bit of crowding in gold right now. Everybody and their mothers have been talking about owning gold in the last couple of weeks. Some fluff has to come out, but I believe that gold will be a buy from this point on because it will thrive under the recession theme. The problem is, if we do have a stagflation theme, gold is not going to perform as many expect and even predict to be. And again, the proof that today was not an inflation theme, I don't know what it was, but it was certainly not a recession theme. Look at the Japanese yen. It was down for the day. So we know for sure, you put it all together, oil is up, gold down, Japanese yen down. Today, the recession fears went away, at least for today. Moving on to the options market, the big casino, what do we see here? All of a sudden, we see a lot of call options buying, as if market participants are saying, we win either way. We want our cake and we're going to eat it too. If we have recession fears, the stock market will go down because the Fed will ease. If we don't have recession fears anymore because the banking crisis is being contained, at least for today, that isn't that good for the economy, and we're going to buy stocks either way. But never in these conversations do we hear inflation. Everybody assumes that inflation is dead now. We'll see what happens. But the hottest stable by far today was Tesla, the souffle, with around 1.3 million contracts traded. About 60% of the breadth was calls versus puts. And at number 2, Apple, with around 700,000 contracts traded today, and the volume is split pretty much 50-50. At number 3, NVDA, with around 500,000 contracts traded today, about 51% of the volume was puts, not calls. And I believe that NVIDIA is ready to go down. And the reason is, look at calls, for example, with the expiration date of this Friday. The majority of them, the highest open interest when it comes to volume, the majority of these calls are now out of the money because call options buyers have been buying the 300 plus, expecting NVIDIA to go to the moon. So now the market maker has to look at all of this open interest below the current price of NVIDIA, and they see very little volume. So now they have to look at puts, and when they do that, there's plenty of open interest open. In other words, the market maker wants to prevent the scenario of all of these strike prices hitting one by one, boom, 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 and then the market maker finds themselves in an unfortunate situation. So they have to get ahead of that by selling shares of NVIDIA. This is the feedback that the market maker is getting right now. I have plenty more open interest open for puts versus calls, and in order to hedge, I'm going to have to dump some shares here. So I believe that NVIDIA is getting to a point here where it's getting closer and closer for a massive pullback. We're talking about anywhere from 5 to 10%. And I believe that we're already in this process right now. Let's move on to the unusual activities that took place in the options market today. We begin with the ticker SPY for the S&P 500. They're buying puts now across the board, not the SPY only, but Qs, IWM, as you can see. But we start with the Qs. They bought the 345 puts for the expiration date, May 5, with expectations that the name will go down and lose more than 13% of its value by then. They paid around 85 cents a piece to enter this trade, all in all spending around $1.7 million. And then here it is, the Qs, another put option trade. They bought the 265 puts this time around with the expiration date of May 5th, with expectations that the Qs will go down and lose more than 14% of its value by then. They paid around $1 a piece to enter this trade, all in all spending around $2 million. And then we have the Russell 2000, the IWM. They're buying puts here too, despite the rebound that we got today. Somebody bought the 150 puts for the expiration date May 5th, with expectations that the name will go down and lose more than 13.5% of its value by then. They paid around 75 cents a piece to enter this trade, all in all spending around $1.5 million. Now my hunch is, given the volume, given the expected move down, this is the same trader buying puts in the SPY, the Qs, and the IWM. Are they hedging? And if they're hedging, why not just buy puts in the SPY? Why buy puts in all of them? I think somebody's betting on a massive pullback coming here across the board. And then we have the ticker GOOGL, Google, a company that we love and adore and we will never ever short. I'm actually shorting it right now, but anyways, we talked about this in Discord. You gotta short Google in the morning, and today it was a beautiful trade. And we have more gains to come. At least according to this trader, who bought the $90 puts for the expiration date May 5th, with expectations that the GOOGL will go down and lose more than 12% of its value by then. They paid around $1.30 a piece to enter this trade, all in all spending around $1 million. On to the heat map. We already talked about it. The theme here is no theme, but the message is clear. The assumption that we are heading into a recession right away, that got challenged today. How did it get challenged? The answer is energy moving higher, gold moving down. We also saw the IWM, the small caps, outperforming large ones. So that goes contrary to the recession theme that has been going on for a few days. And then we see the big caps down, along with chips, along with Chinese names, along with a lot of software names. What is the message here? Maybe we don't have an expansion theme. On the other hand, what continues to outperform is healthcare and staples. Now let's talk about some corporate news here, and we start with Schwab. A lot of folks got mad at me from Schwab when I posted on Twitter the numbers that they released. And I said, you gotta be careful here. Something bad is happening in Schwab. And I'm gonna take my money out. I'm not gonna sell my stocks, but I'm taking my outstanding cash balance out of Schwab. And folks accused me of spreading fear and maybe I'm short Schwab. What the hell are you talking about? I have my money in Schwab. If they go down, I go down too. And the CEO comes out and says, oh, I'm buying shares. I'm going to pump and dump. Maybe you should have faith in Schwab. I say I'm only going to have faith in Schwab if you guys release the new numbers. Show me the new balance sheet. And if you can't, then I'm not going to have any confidence at all. And the problem with Schwab right now is if you look at the credit default swaps, they're skyrocketing. This is not a coincidence, folks. Something bad is happening in Schwab and they're not talking about it right now. I sincerely hope that I'm wrong. But right now, the evidence says that I'm not gonna. There's a big problem happening in Schwab right now. And then we move on to the tsunami of layoffs, and this time we have Disney once again with CEO Bob Iger, who announced that Disney will lay off more and more and more employees. Now, as a Disney shareholder, which I'm not, you want a ruthless CEO such as Bob Iger. You know, Bob Chapek was into the woke shit, and he was so hesitant to fire employees. He didn't want to jack up the prices in Disney Plus. Bob Iger is a different class of human being, if we can even call him that. He's not going to hesitate to fire employees. 10,000, 20,000, 50,000, all employees fired, doesn't matter. He's going to pump the stock higher. He's going to give you value for your money. He's not going to hesitate to raise prices on Disney Plus, in the parks, in everything. Step number 1, announce massive layoffs. Step number 2, jack up prices higher across the board. Step number 3, destroy your enemies. Bob Iger is your man. He's going to go the distance. He's not going to give up until he wins. And by winning, he means pumping the shares higher. Then he takes the parachute, he sells a bunch of shares, dump them on your head, and says goodbye. Take, for example, the mafia operation we call the iMob, Apple Incorporated. Now that shares of the company pumped higher beyond any reasoning at all, why would I pay over 25 times sales when we have a recession coming? But anyways, this has been good enough for the executives to start dumping shares. And you got the CEO this time around dumping about $30 million worth of Apple stock. And many more to come. I bet Tim Apple will be next. And speaking of dumping shares, maybe if you happen to be a Tesla shareholders, watch out here, because your boy Elon Musk, Reverend Elon, you might need to take another massive dump on your head. And the reason is things are not going pretty good on Twitter. You got ex-employees right now sabotaging the company. Elon Musk even says that Twitter is now worth half what he paid for, and maybe it's not going to work out at the end of the day. So he needs more and more cash to pour into this dead horse. And this is, of course, unfortunate because we support Elon Musk. I personally happen to be one of his biggest critics, but I support him in this issue. I support him on the Twitter endeavor. Because whether you like him or not, he's cleaning up the deep state filth on Twitter, which was not enjoyable at all. It was all manipulate the algos to pump up whatever issue, whatever narrative they want us to hear. And it was a clown show. Now at least you can see both arguments, both narratives. And therefore we support Elon. We hope that he will succeed in this endeavor. On to the heat map for the ETFs. What do we see here? Once again, energy higher. That's inflationary. Financials rebounding, XLF, XRE, even the IWM altogether. Maybe that's short covering. But what's up with the exodus from technology and large caps? What is the message here? Is it the market finally realizing that these are not safety? The SMH chips down over 1% for the day. What is the message here? Are they afraid that we're going to see the revival of the inflation theme, that yields will move higher again, and this will trim the valuation of these companies? Maybe. We'll have to wait and see. Now, when it comes to other ETFs, mostly in the green, but we can't read too much into the action today because all what we know is, okay, recession fears went down by a little bit today, and we have some short covering in the small caps / regional banks ETFs. That's all. We have to see what's going to stick here. And I'm going to use the bond market as my indicator. Today, the TLT was down big. Bond prices were down big. What I think the market is saying right now is not too fast with the recession theme. It's going to happen, but the inflation problem hasn't been solved yet. And we have to pump yields a little higher and see what the Fed is going to do. It's the Fed's call right now. Do they want to ignore the evidence? Maybe PCE inflation on Friday will give us new insight, up or down on inflation. Maybe the Fed will cut rates either way. But until we know, the market today said inflation is not gone yet. Inflation remains a problem. Let's move on to charts, and we start with SPY, the S&P 500, 30 minutes chart. What do we see here? It is the battle of 398. You can say it's the battle of 400, depending on what your chart says. But mine says 398. And we closed below the important number, forming a bear flag pattern. Sure, we have some soft support at around 396, but if this decline continues, we're going to go down all the way to 393.58. That will be support number 1. And if it is broken, we go down to 390. But hold your horses here before I get too bearish, because when you look at the daily chart, what do we see here in the continuous contract? A bad closing candle, not looking good. You can say it is a shooting star, reverse whatever, a Dracula sign, doesn't matter to me. It's a bad closing. Why? Because the chart went all the way to the resistance at around 4,000, couldn't make it, and it closed below the open, indicating a possibility of a reversal. But the confirmation would be if the chart goes down and breaches below 3,900 160 as support, closing the day below that number. Some traders have a lot of risk tolerance and they say, okay, I've seen enough, I'm going to short right now. Some want to wait for confirmation. Whatever floats your boat. Doesn't matter to me. We'll look at the Qs, 30 minutes chart. What do we see here? Obviously, 313 is a no-go for now, absent of new evidence. So now we have 309. And maybe the bear flag from last week was not good enough, but what if we formed perhaps a better bear flag this time around? And it is already playing out, and the chart closed below 309, showing the beginning of weakness in the Qs. But again, we have to look at the daily chart. When we do that for the continuous contract, no damage done. The support of 12,766 remains intact for now. All what the chart did gave it another shot at the resistance at around 13,000. Couldn't make it, and that's it. Reversal? Sure, but without confirmation. The confirmation would be closing below 12,766. Absent of that, we don't have a reversal plus confirmation. Look at the hour side, the MACD indicators. They're kind of stalling here. They're not showing signs of a reversal yet, but they're showing signs that the Qs is running out of gas. What do we do with the IWM and hourly chart for small caps, the Russell 2000? All what it did today, short covering, a gap higher, but it did not manage to close above the important number of 174.22. I gotta see it to believe it. And I told my viewers in Discord today that absent of the IWM trading above 174.22, the rip in regional banks will not last. It will be a gap and crap. Now, if the IWM trades above 174.22, then we have more gains to come in regional banks, and they could be massive. So you can play some of these moves higher. But keep in mind, we'll look at the daily chart for the IWM, look at the momentum indicators, the hour side, the MACD, all saying there is room for a rally here. And the rally could take us all the way to 176.52, for example. You can play that. But bear in mind, when we look at the weekly chart, not looking so good. It's looking shaky. What if any rebound we get right now is just a mere formation of a bear flag pattern on the weekly? And sooner or later, it breaks out and we lose 163.62 as support. And here comes the waterfall of selling. The dollar daily chart, what's going on here? Closed below the important support, now resistance at around 103. Is there a clear message by the dollar today? Of course not. It is consolidating for now. We're not seeing a major move higher, indicating that the Fed might resume the fight against inflation by being more aggressive in tightening the monetary policy. But we're not seeing a flush down either, indicating a rush to safety besides the US dollar. So for now, nothing to see. And nothing to see is not good for the old man gold. He needs some directions. For now, we know that we have a double top. We talked about a pullback coming for gold. It is too crowded right now. The hour size negative divergence. The MACD indicator is curling down, indicating weakening in momentum. The good news is the support of 1928 remains intact. What I see is a pullback in gold. It will give you a good buying opportunity, a better buying opportunity. Why the rush? Why stampede without clarity? You got to make sure that we have a recession theme in play, not a stagflation theme in play. Because if it is the latter, then gold is not going to perform as we expect it to be in a recession theme. And I'd rather be in silver. Look at SLV, for example, because it has a lot of catching up to do with gold. We talked about filling the gap at 21.57. We did that, and I said it will give you a buying opportunity, a dip buying opportunity. Perhaps we're here right now. I see SLV consolidating at this point below 21.57, gathering the energy needed to break above it once and for all. When we look at UK oil, Brent oil, we're now above 77, but can we close the week above this number or not? If we do, then the worst case scenario for energy has been averted. Or shall we say, kick the can down the road? It's going to happen at some point, but maybe it is delayed for now. Maybe we'll have a stagflation theme for a little while. When we talk about the 2-year yield, what do we see here in the daily chart? It managed to rebound today and catch the line of support right now. Used to be resistance, now support. And it caught a lot of market participants by surprise. A lot of folks assumed that we have a crash coming in yields and a massive rally coming for bonds because we have a recession theme. The market today says not so fast. The inflation risk is not gone yet. You people are out of your minds, assuming that inflation is now gone somehow. And the same goes for the 10-year yield. It managed to rebound significantly, and now it's trading above 3.5. The message, once again, the fight against inflation is not over yet. Look at the TLT. It's down for now. Could lose a little more momentum. Retest 103.5, see if that's going to hold or not. If not, we go down to 100.28. What about the VIX 4 hours chart? What do we see here? My hunch is the VIX is gathering energy, going back and forth to blast significantly higher. Now, a lot of of you say, oh, the VIX is down to 20, I'm going to buy some weekly puts right now, because puts are cheap, Maverick says. Not really. The VIX tracks 30 days plus till expiration options. Put options, I should say. When you see the VIX down at 2018, you got to start buying longer term put options. Those are the ones that are becoming cheaper, not the immediate ones. What is the harm here of going 30 days plus? Go to May expirations, for example. You get it wrong, you have the time to do some repair. You have the time to get out with minimal damage. But you buy weekly put options, you buy options with 10 days, 14 days till expiration, and you're going to have very little room for maneuver in case you're wrong. Apple, an hourly chart, what do we see here? Losing a lot of steam, Apple here. Negative divergence on the RSI, negative momentum on the MACD indicator. We have a line of support. And if that's broken, I believe that Apple is going to flush down all the way through all of these soft supports down to 150. And that will be music to the ears of bears. And then we have the battle of 150. Tesla, an hourly chart, what do we see here? Every time you catch a pump, it doesn't last. We see gap and crap, now forming a bear flag pattern below 194.55. Now we have 187.68 as the next support. We'll see what happens. When it comes to Tesla right now, it becomes a battle of psychology. Most importantly, from the bearish side is a lot of people bought Tesla earlier this year. So the momentum ran out of steam. Either you bought Tesla, either you bought call options, either you're already in or not. And now the holders of Tesla are looking around and saying, anybody on the sidelines want to jump in? Because we're not going to move higher until more volume from the sidelines start to jump in. If that doesn't happen, then the psychology goes as the following. If you bought Tesla earlier this year and you're holding profit for now, what if it goes down 187.68? Then it goes down to 180. At what point do some of the holders of Tesla say, okay, we've made enough, I don't want to take the risk here in losing my gains, and they start to stampede to the exit door? That would be the moment when Tesla flushes down all the way to closing the gap at around 144. But there is still hope for the holders that maybe new blood is going to show up somehow, somewhere. If you look at the daily chart, we have a bull flag consolidation pattern. If new blood shows up, higher we go. But the bears would argue and say the 4 hours chart is the leading indicator for the daily. And what we see right now in this chart is lower highs, with the most important support being 183.24. If Tesla breaches through this number, we will see a lot of capitulation by the holders. They will stampede to the exit door, and that will take us all the way down to closing the gap at around 144. Bitcoin, a daily chart, what do we see here? We got a retest at 26,555, holding for now, but we have a negative divergence on the RSI. We have signs of loss of momentum on the MACD indicator. If we have a shift from risk on to risk off, then Bitcoin is going to lose that support, because right now it is looking for buyers. It made a move, now it wants more blood. With no more blood showing up, the sellers will push the button and say, okay, we made enough gains. I don't want to wait till 23,000 before I book my profits. I want to book them right now. And here are some bonus charts for you. We begin with the ticker MOS Mosaic. I've been talking about this name for a while now. I did buy some call options with the intention of converting them into shares in case MOS trades above 50, let's say by the end of May. But for now, what we know from the daily chart is we have severe oversold conditions. We're waiting for a bounce. We're waiting for a rally. That should take us all the way to at least closing the gap at 46.58. And you might have noticed today, midday, when the contract for natural gas got updated, out with the old, in with the new, we saw a rebound in Mosaic shares. So keep an eye on this one. And then, based on the viewers' demand, we have URA, uranium. What do we see in uranium right now? It's the same story as Mosaic. It's almost an identical chart right here. A daily chart, URA, you look at the RSI, the MACD indicators, this baby's ready for a pop. Does that mean you should own it for the long run? Not really. But can you trade a pop higher? Sure. And the next target we have is the high of this candle right here, which happens to be 1960. And then we take it from there. Anyways, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have retail inventories along with wholesales inventories, and that comes on top of the Case-Shiller Home Price Index, along with the FHFA Home Price Index, and lastly, we also have the U.S. Consumer Confidence Index. And this is going to be day number 2, where Governor Barr is going to testify about the banking crisis to the Senate this time around. He talked harshly today, but who cares? At the end of the day, they missed the obvious. There was a lot of risk-taking in SVB, and the Fed missed it. The Fed should be on the chopping block here, not SVB. But anyways, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Schemers trying to control their little worlds. I'm not a schemer. I try to show the schemers how pathetic their attempts to control things really are.